Hello everyone, welcome again to I7, the statement of cash flows. And today we're just going to take a look at on investing activities as well as financing activities before we go deep into the question, into how to solve the question. All right, let's now go. Here we are, investing activities. What are investing activities? When we speak of investing activities, actually, we refer to acquisition and disposal of non-current assets and other investments not included in cash equivalents. I don't know if you get me. When speaking of acquisition, that means we try to determine the amount of cash that has been given out so as to obtain non-current assets and other assets but which are not cash equivalents. All right? Or mean and other investment not in cash equivalents, but also speak of disposal. When speaking of disposal, it means that when you sell a non-current asset or any investment not in cash and cash equivalent or not in cash equivalents, actually we mean that we obtain cash, we'll have cash inflows. So it doesn't matter whether you give out cash or you receive cash in respect of non-current assets and other investments not in cash equivalents, because if you are given an investment, let's say they are in current assets, and you are told that actually they can be realized in 3 months' time, that means cash equivalent. So that won't form part of the investing activity. So you have to know that. So what we need to know here is that investing activities show the extent of new investment in assets, which will generate the future profit and the cash flows. So, simply speaking, when approaching the investment activities question, you have to take a look at your pro forma just like this. This is your pro forma. For example, I could say, maybe I've acquired non-current assets. Non-current assets could be anything, could be property, plant, and equipment, could be investment properties. Actually, it could be anything, could be intangible assets. So it doesn't matter as long as you have just invested in non-current asset and other investments. When speaking of other investments here, we mean, let's say, investment in debt, investment in equity instrument. Let's say the company has invested in shares of another company. Actually, the company will have to pay some cash, so there will be a cash outflow. That's why when speaking of acquisition of non-current assets, it will be a cash outflow. So it doesn't matter whether it is acquisition of non-current assets or investment that are not cash equivalents, it will all involve cash outflow. So it's just like that. But also could have disposal of non-current assets in the same and other investment, not in cash and cash equivalent. We would obtain something we call sales proceeds as long as we receive those proceeds in cash. All right, because it could be right that you have received proceeds, but they are not in cash. Maybe some amount is in cash, but some amount is in the form of a receivable. So you'd have to account for that respectively. All right. But also you could, let's say you have invested in non-current asset investments. Ignore non-current asset. Let's say it's non-current asset, but they're investments. Let's say you've invested in shares of a company. You have invested in debt of a company. If you invest in shares, you expect to receive dividends. So you could have dividend received. If you've invested in debt, actually you could be entitled to receive interest, so you could have interest. So it doesn't matter whether it's interest, it's dividend, or it's rent received. If you receive that from your investment, that means it's the product of your investment. So it will be a cash inflow and you would have to record it. And then down here, you would have the net cash inflows or outflows from investing activities. So if it's positive, we say inflow. It's negative, we say outflow. Just like that, and everything becomes over. All right, now we can just go to the another portion of financing activities. Note that for operating activities, you could just go to the previous lecture. I explained it in deep, in well, both for direct and indirect method. All right, now let's go to the financing activities. So when dealing with the financing activities, as normal, when approaching a cash flows question, you are normally given the income statement for the associated year, but you are also given the statement of financial position for the current and the previous year. So as to do that. So when speaking of financing activities, these are simply activities that cause changes in the size and the composition of equity capital and the borrowings of the entity, usually long-term borrowings, because if for short-term borrowing like bank overdraft, we usually put them into cash equivalents. All right. So you just go to the section of the statement of financial position. The statement of financial position usually has assets first and then equity and liabilities. Now, As for equity, you take it all. We say equity capital. It doesn't matter whether it's share capital, share premium, retained earnings, revaluation surplus, whatever, as long as it is in the equity section, but also borrowings of the entity, most of time long-term liabilities, because short-term liability, like let's say tax, actually you could already find them in the tax account. Trade payables, you could find them in the working capital as seen in and operating activities. So that's what you could find there. All right. So to get more details, say this section shows the share of cash which the entities capital providers have claimed during the period. Of course, if someone is provided with capital and then you have made a repayment, we could show the amount that they have claimed. But not only that, if someone has given you capital, you could have paid them dividend. Let's say you have issued shares and someone has subscribed such shares. So you could also incorporate that issue here. All right. So it's just like that. So we say this is an indicator of the likely future interest and dividend payments. So that's what the cash flow entails. And lastly here, we have the pro forma. So as I said that, you take a look at anything that affects non-current liabilities and equity. For example, now, if you go under equity, you could find something like issue of shares. If you issue shares for cash, you'd record it this way. You have to be careful because you can issue shares not for cash, but don't worry about that. We'll go and take a look at all control accounts, share capital, share premium, retained earnings, revaluation surplus, everything. We'll take a look at that when approaching the question. So just stay tuned. All right, here we are. We say that you could have issued debentures, loans, loan notes, or bonds. So it's all the same thing. They are all liabilities. So if you issue them, that means someone pays you. So if someone pays you, you'd have cash inflows, just like issue of shares. But also, you could raise loans from a bank. You know, we usually separate bank loans and these other loans. There are loans that are marketable and but bank loans are not marketable. So it's just like this. So you just separate them. And the difference between bank loans and these marketable loans is that bank loans are usually paid part principal and part interest. But normally these other loans like debentures and loan notes and bonds, these are market, they are tradable debt in the market. And so we usually pay interest first, and then at the redemption date, we repay the principal maybe at a premium, at a discount, or at par as it was issued at the beginning. So it's just like that. So you could also redemption of entities, shares, or bonds. Let's say you had issued the preference shares. Preference shares are usually repaid after a period of time upon maturity. So if you redeem, but if you have paid them back, this would be a cash outflow just like that. But also you could have repaid loans. Let's say bank loans, you have repaid bank loans. If you repay the bank loans, actually, it would also be a cash outflow. So it's just like that. But also you could have dividend paid. Dividend paid. Let's say dividend pay, you have paid someone dividend, you have paid shareholders dividend. It would be here. Now, not one thing. If dividend paid is paid to equity holders, why not show here interest paid to actually bond holders? It could be very, very possible. So interest paid, instead of being taken under operating activities, as shown in the previous video, could also be taken down here. But the company should operate this consistently. But usually interest usually comes for running the business. So because we usually associate it with business, it's a normal practice to put it under the operating activities. After obtaining cash from operating activities, then we deduct it to obtain the net cash. So it's just like that. All right, after here, you would have the net cash inflows or outflows from financing activities. So that's how you account for investing and cash flows from investing and financing activities. So you have to know that. All right, thank you very much. And until we start the real example. So stay tuned until that. All right, thank you very, very much. And bye. Subscribe if you want to subscribe to this channel. All right.